I would agree. I don't think we've even begun to see anything yet, and I think that's by design. I think rising gold devalues the dollar, and that's what they're trying to do. You don't devalue the other currencies around you or devalue the dollar against other currencies. They'll just keep devaluing theirs. That's what Triffin's dilemma is all about. But you let gold go higher, which is the true barometer of the health or the measurement of a currency, and you see the dollar will start to devalue more and more and more. And that's, I think, what they will do. I think saving in dollars, you're destined to go broke. Rick Rule, our mutual friend, says this all the time. If you are not a contrarian, you'll be a victim. And I think that's what he's getting at, is that holding your wealth in dollars is really, like I said before, akin to holding a melting ice cube. It is not a good store of value whatsoever. And you can see that. You can see that just by doing exercises just like this to see in gold terms any asset you can think of is going down in price. It's deflating against real money. I think the public will be last to the party. The industrial demand, I think, will come to some sort of a very large battle with the big funds, the big money that's doing it from an investment standpoint, who will have a very hard time ignoring the gains that we're seeing in these markets that are blowing through all resistance levels and have outperformed everything. So at some point, ask yourself who stood for delivery for 38 million ounces in the last week on COMEX, and who stood for delivery for almost 70 million ounces last month. And is it the federal government? Is it Tesla, Samsung? We already heard how Samsung's gone to Mexico and dealt directly with the mine by buying doré concentrate. But that's the same thing I've been saying for 2 years now that China's been doing, as I was told by Sean Kuhn, a mutual friend of ours, the CEO of Dolly Varden, and Keith Neumeyer talks about it, how China is going directly to Mexico, the number one producer, China's two, and to Peru, the number three producer, and buying all their pre-refined silver in the form of doré concentrate, paying double what the West will, shipping it back to China to refine it. Well, that's the exact same thing that Samsung is now doing. So you're seeing a situation where at some point the industrials who have to stockpile say, my God, it's going so fast and now everyone's going to buy it. If we don't jump in and take millions of ounces, we could be in big trouble. So you will see the industrials battle I believe, the hedge funds at some point and push the price massively higher. At the same time, now you have the governments involved as a critical mineral and limiting exports. And there are very few commodities that have plurality in use, right? Like you have monetary, you have military, you have industrial, and many forms of industrial. And you have all the players in that game that are all saying, well, geez, I need it. And now you have the U.S. government amongst the European Union and now China, the real big boys and girls in the room who are saying, but we need it too.
What has changed is not just demand, but who is buying and how. Major manufacturers are increasingly bypassing traditional exchanges, securing raw concentrate directly from miners through private agreements. China has pursued this strategy quietly for years, locking in supply from Mexico and Peru at premium prices. Now Western corporations are adopting the same approach. Governments have entered the arena as well, designating silver a critical mineral and tightening export controls. Unlike most commodities, silver sits at the crossroads of monetary, industrial, technological, and military demand. When corporations, investors, and sovereign states are all competing for the same finite resource, price becomes secondary to access.
And so between the industrials, the governments, the investors, and then the retail investors who will get the scraps into a depleting pool of availability, where we're now 6 years in a row in a structural imbalance between supply and demand. Only about, 18% of what was mined last year, of the 800 million ounces, only about 160 million of the 800 million came from companies mining silver. That's it. The rest of it, and less than that, comes from byproduct mining of copper, lead, and zinc. And so, yeah, it's becoming something where demand is massively increasing, hasn't hit the mainstream yet for the retail public, but it's being driven by the highest money in the world at a period of time when we're going deeper and deeper and deeper into an imbalance between supply and demand. Mm-hmm. And it's coming out of the ground at 7-to-1. In other words, 7 ounces of silver for every 1 ounce of gold, yet it's still priced at upper 50s, 56 to 1, but it was at 120 to 1 in March of 2020. It was at 85 or 90 to 1 most of the last several years. So it's beginning to move back towards not only its historical ratio, and everything always does regress to the mean, regress to the average. How low does it go? Don't know. But if you told me that it would, would regress into 30-ish to 1 or 20-ish to 1, I mean, that's totally logical and still many times higher than it's being pulled out of the ground at and depleting, disappearing. So you look at all the silver used in military applications and industrial applications, and the military applications have blown up, and the industrial applications, because such a small amount is used, most of it doesn't get recycled. It's in landfills. So it's depleting, it's disappearing, it has multiple uses, and now being challenged by sovereign nations. It's, I think, the buy of a generation.
Silver's fundamentals are far tighter than most investors realize. Global production is roughly 800 million ounces a year, yet less than 20% comes from primary silver mines. The majority is produced as a byproduct of copper, zinc, and lead mining, which means supply cannot quickly respond to higher prices. At the same time, industrial demand keeps rising, driven by electronics, solar energy, and defense applications. Much of this silver is effectively unrecoverable, ending up dispersed in products or landfills rather than being recycled. The result is a structural deficit that has persisted for 6 consecutive years, with demand consistently outpacing supply. The silver market isn't just tightening, it's quietly being depleted.
The dollar that we think is a good store of value is more like a melting ice cube. And what gold and silver are amazing stores of value. I can show you some numbers very easily. But we're first of all, we're told that the dollar was only down 9 or 10% against the dollar index, but that's a very poor measurement because of Triffin's dilemma, which says that countries will always need, you'll run a trade imbalance always if you're the world reserve currency, because countries need to sell their currency to buy ours in the open market. We don't provide them enough dollars through trade alone. They're constantly devaluing their currency against ours, so we're measuring the value of our currency against a basket of crappy currencies that continually devalue against ours. It's a poor measuring stick. Look at gold and silver, and you'll see that the dollar was down 150% against silver and 75 or 80 against gold. But I'm going to give you a good analogy or a good example of what I was talking about. So I'm just going to use my phone here. I'm going to put my glasses on so I can see. Maybe jot these numbers down for me, Daryl.
Yeah, I got you.
So here is the average house price in 2025. The average house price in 2025 is $530,000, okay? The average house price in 2005, 20 years ago, was $232,500. And then if you look at what was the average gold price in 2005, write this down, $445 an ounce. And today, price of gold is $4,600. So, okay, let's do the math. So, what was the average price of a house in 2005?
I was at 232,000.
And what was gold?
445.
All right, so 232 divided by 445 is 521 ounces. So 20 years ago, you're saying to your wife, should we spend the 520 ounces that my grandfather left us and we'll have no debt? We can buy this house outright.
Silver's fundamentals are far tighter than most investors realize. Global production is roughly 800 million ounces a year, yet less than 20% comes from primary silver mines. The majority is produced as a byproduct of copper, zinc, and lead mining, which means supply cannot quickly respond to higher prices. At the same time, industrial demand keeps rising, driven by electronics, solar energy, and defense applications. Much of this silver is effectively unrecoverable, ending up dispersed in products or landfills rather than being recycled. The result is a structural deficit that has persisted for 6 consecutive years, with demand consistently outpacing supply. The silver market isn't just tightening, it's quietly being depleted.
It doesn't pay any interest, or I guess we could stick it under our mattress and earn nothing but dust for 25 years, if that's what we really want to do. The mortgage will almost be over by then. We'll own the house free and clear, and hopefully gold goes higher. And you guys decide, yeah, let's do it. So we look at the price of a house today, which has almost doubled in dollar terms. Is that correct?
Yeah, we're at about 535K.
So it's doubled, 232 to so great. You doubled your money and you got your gold. Sounds good, right? Well, it is good because if we take a look at not selling that gold, and what I'm getting at here is that anything that you value as an asset price in dollars looks like it's going way up. It's doubled, over doubled. Measure it in gold and the prices are collapsing because what are 521 ounces of gold worth today times 4,600? You're at almost $2.4 million, which buys you 5 houses at today's prices. 5. And that didn't earn any interest. So what gold is a way to maintain your purchasing power and in some cases accentuate it. Now you can take any asset you can think of and do this with. Go back to 1971 and you'll even see since we left the gold standard that all asset prices are deflating against gold and massively inflating against a falling dollar. So in other words, gold didn't go higher, the dollar just keeps falling. And that's built into the system and it's accelerating. So yes, you own gold not to become wealthy, but because it is wealth that has outlasted 2 world wars and German hyperinflation and the Great Depression and every pandemic and everything. Mentioned cumulatively 700 times or more in the Bible, and here we are 6,000 years later, and what do you know? Things have come not really, well, they have come full circle, and the most well-informed traders in the world are rushing to accumulate it and repatriate it and take possession of it quietly that no one really sees.
Measured in dollars, asset prices appear to be soaring. Measured in gold, many are quietly collapsing. That contrast isn't a coincidence. It's the result of currency dilution. The dollar index obscures this reality by measuring the dollar against other weakening currencies, masking its true loss of purchasing power. Gold and silver tell a far more honest story. Over the past 2 decades, gold has preserved, and in many cases enhanced, purchasing power, while holding cash has steadily destroyed it. A home that once required several hundred ounces of gold now demands far fewer. Gold didn't suddenly become more valuable. The currency simply became less reliable. That distinction is crucial, and it's one most people underestimate.
I would agree. I don't think we've even begun to see anything yet, and I think that's by design. I think rising gold devalues the dollar, and that's what they're trying to do. You don't devalue the other currencies around you or devalue the dollar against other currencies. They'll just keep devaluing theirs. That's what Triffin's dilemma is all about. But you let gold go higher, which is the true barometer of the health or the measurement of a currency, and you see the dollar will start to devalue more and more and more. And that's, I think, what they will do. I think saving in dollars, you're destined to go broke. Rick Rule, our mutual friend, says this all the time. If you are not a contrarian, you'll be a victim. And I think that's what he's getting at, is that holding your wealth in dollars is really, like I said before, akin to holding a melting ice cube. It is not a good store of value whatsoever. And you can see that. You can see that just by doing exercises just like this to see in gold terms any asset you can think of is going down in price. It's deflating against real money. And that's the whole reason to have a gold standard, is that you have stable prices, or even that deflate. In other words, a better standard of living, right? If prices are going down and, but instead prices keep going up, which makes wealthy wealthier, right? This is the whole concept of those closest to the gold or to the money spigot become wealthy disproportionately to those that aren't, because those people who have assets and can buy more assets, their value goes way up. And you contrast it with the people who don't. By the time the money gets filtered down into the public who don't have assets, just trying to make ends meet, it manifests in the form of higher inflation, higher costs of living. And that means the wealthy whose assets are inflating become exponentially more wealthy, and the people who don't have assets, just trying to keep it all together, well, they're having a harder time doing it. It's the K-shaped economy, and that's where we're going. And you can see it very easily if you take a look at this type of measurement.
Yes, pullbacks will happen. Precious metals markets are thin, emotional, and heavily leveraged, so sharp corrections are a natural feature of any bull cycle. Volatility, however, doesn't alter the underlying reality. Physical supply is tight, delivery demand is rising, and institutional accumulation continues to grow. Margin hikes, profit-taking, and alarming headlines can rattle prices in the short term, but they don't create new metal. The real risk isn't temporary price weakness. It's waking up to a market where physical silver is scarce, premiums have surged, and availability has evaporated. In that environment, pullbacks aren't warnings, they're opportunities.
I don't think it's too late at all. Um, but at the same point, I think that a little bit of caution is not bad idea either. And you know, especially after a move like we've just seen, and the old adage, when everyone starts talking about something as a certainty, that's usually when the market reminds you it's smarter than you and it doesn't care about your conviction. But I would separate price risk from thesis risk. In the short term, yes, silver and gold can absolutely pull back, and silver is a thin market. And after a vertical move, you can often see what's called a sharp air pocket where profit taking comes in. You can see the margin pressure that the CME group keeps raising margins to knock people off on margin. People standing for delivery right now are not using margin, so all it does is give them more metal at lower prices. You'll see headline risk that it's overbought, etc. And you'll see corrections, sharp ones, in 10 or 20 bucks in silver, 100 bucks in gold. Gold's up 100 bucks today. Why is no one complaining? If it goes down 100, they'll all freak out. But this is normal in a bull market. It is the underlying conditions, however, that got us here, and that's tight physical availability coupled with massive delivery demand in a paper market that has been asked to settle real-world demand in real metal that it may not actually have. So yes, Daryl, if you're asking me, could we see gold and silver drop next week? Of course. I'd actually be surprised if we didn't get some violent pullbacks along the way. But if you're asking me, does a pullback change the bigger picture? Hell no. In fact, I think it's a gift. Why? In a market like this, why? Not because I'm trying to sell people the products that we sell, but because these moves are usually driven by positioning and by leverage, not by a sudden surplus of available gold and silver. So if you're trade, but if you're trying to protect your purchasing power, the risk isn't that silver goes from 80 to 70 for a minute or gold goes from 46 to 44 or 4,000. The risk is waking up in a market where you can't get what you want at any reasonable premium or price, and the price you thought you'd be able to buy it at is gone. So short-term caution, sure. Long-term conviction, absolutely. And in my opinion, both can be true at the same time.